February 10th, 2026, 7:32 p.m. Eastern Standard Time. Silver closed at 80.59, bleeding red. The institutions wanted panic. They wanted surrender. But then, something happened in the darkness. Within 90 minutes, 80.97. A recovery that wasn't supposed to exist. 47,000 contracts. Disappeared. 11,000 more. Appeared from nowhere. Someone knows something the headlines aren't telling you. And what happens in the next 14 hours could reshape everything you thought you understood about this market. Welcome to your OG John AG. Yay. Now, before we dive deep into what really happened during those critical 4 hours, I need you to do something for me. You see that subscribe button? The one right there below this video? I know. Everyone asks you to click it. But here's the thing, friend. You've lived long enough to know when information matters, when analysis cuts through the noise, when someone's telling you the truth instead of reading corporate scripts. So go ahead, hit that button, the red one. It takes 2 seconds, and it ensures you don't miss what's coming next. Because what I'm about to show you, the patterns, the data, the institutional positioning, this isn't just another market update. This is a warning signal. And before we begin, drop a comment below and tell me, where in the world are you watching this from right now? New York, London, Singapore, Mumbai? I want to know where this message is reaching. Because what's happening in silver, it's not a local story anymore. Now, let's talk about what they don't want you to see. At exactly 4 p.m. Eastern Standard Time on February 10th, 2026, the New York trading floor closed its doors. Silver had settled at $80.59 per ounce, down 177 from the previous day. The closing bell rang. Traders logged off their terminals. The official number was recorded in every financial database across the world. $80.59. Red candle, bearish close, end of story. Except it wasn't the end, because 90 minutes later, something unexpected happened in the electronic trading system that operates while New York sleeps. The Globex overnight session showed silver trading at $80.97, a recovery of 38 cents in after-hours trading. When most retail investors had already turned off their screens and gone home, this wasn't normal market behavior. And the professionals who watch these patterns every single day knew it immediately. To understand why this matters, one must look at what happened during that final hour before the close. Between 3:00 p.m. and 4 p.m. Eastern, the silver market processed 47,000 contracts. 47,000. The average final hour over the previous 30 trading days? 31,000 contracts. Someone had brought 16,000 extra contracts of selling pressure into that last 60 minutes. That's not random. That's not organic market flow. That's coordinated positioning. Someone wanted silver under $81 before the closing bell. Someone needed that daily candle to print red. Someone was constructing a narrative that the rally had topped out and the correction was beginning. But the recovery told a different story. Within those 90 minutes after the official close, the Globex session had already processed 11,000 contracts. On a typical evening, that same 2-hour window would see maybe 8,000 contracts, 3,000 more than usual, all of them buying. This created an unusual pattern. Heavy selling into the close, immediate buying in the after-hours session. A failed attempt to establish downward momentum followed by rapid price recovery. Market analysts who studied the volume patterns noticed something else. The selling in that final hour came in waves, large blocks hitting the bid. Sequential orders designed to overwhelm available buyers. Classic institutional selling technique. But the after-hours buying? Different pattern entirely. Steady accumulation, consistent bid support, patient positioning, 2 different types of market participants, 2 different strategies, one trying to push the price down, another waiting to buy the dip they created. The question wasn't whether this was coordinated activity. The data made that obvious. The question was why. Why would institutions spend millions of dollars creating selling pressure into the close, only to watch that price level get bought back within 90 minutes? One possibility, they needed the official closing price under $81 for derivative settlement purposes. Options, futures contracts, structured products that reference the official closing price. Another possibility, they were testing the market, probing for weakness, trying to trigger technical selling and stop-loss orders to see how much liquidation they could generate. But the market didn't break. It absorbed the selling. And then it bounced. This pattern has appeared before in financial history. In 2008, during the early stages of the credit crisis. In 2011, before silver's final surge to $50. In March 2020, during the COVID liquidity crisis. Each time it signaled the same thing. Institutional players positioned on opposite sides of a trade. One side trying to maintain control, the other side accumulating aggressively. And in each historical case, what followed wasn't calm consolidation. What followed was violent price movement in one direction or the other. The events of February 10th revealed a market under stress, not the kind of stress that appears in headlines or television commentary. Structural stress, the kind that exists in derivative positions, hedging requirements, and institutional balance sheets. The silver market had just experienced what technical analysts call a failed breakdown, an attempt to establish downward momentum that gets rejected almost immediately. And when breakdowns fail in commodity markets, especially in metals with tight physical supply and large paper derivative positions, the movement that follows tends to accelerate in the opposite direction. The clock was now ticking toward the New York Open on February 11th, 14 hours away. And the question facing every institutional trader with silver exposure was simple but critical. What happens when the full weight of American trading volume returns to a market that just rejected a coordinated selling attempt? Imagine borrowing your neighbor's car to sell it. You don't own the car. You borrowed it. You sold it for $50,000. Your plan is simple. Wait for the car's value to drop to $30,000, buy it back cheaper, return it to your neighbor, and pocket the $20,000 difference. But then, something unexpected happens. That car model gets discontinued. Suddenly, everyone wants one. The price doesn't drop to $30,000, it climbs to $70,000. Now you have a problem. You still have to return that car, and it's going to cost you $20,000 more than you received when you sold it. This is called a short position. And in the silver market right now, multiple large institutions are holding the financial equivalent of borrowed cars they sold, watching the price climb, knowing they eventually have to buy them back. The scale of this positioning is difficult for most people to comprehend. In January 2026, estimates suggested that major banking institutions held short positions representing approximately 400 million ounces of paper silver. Not physical silver, sitting in vaults, paper contracts. Promises to deliver silver at a specific price, 400 million ounces. To put that in perspective, total global silver mine production in 2025 was roughly 800 million ounces for the entire year. These institutions had sold half of a year's global production without owning it. This creates what market professionals call a structural imbalance. For decades, this system worked because silver remained relatively stable. Prices moved in predictable ranges. Short positions could be maintained, rolled forward, and managed without significant stress. But something shifted in late 2025. Industrial demand began accelerating faster than analysts had projected. Solar panel manufacturing in Asia consumed more silver than expected. Electronics production didn't slow down despite recession fears. Defense contractors increased orders for silver-based components. Meanwhile, mine production faced unexpected challenges. Labor disputes in Mexico, environmental regulations in Peru, technical problems at major facilities in Australia. Supply tightened while demand grew. And those institutions holding massive short positions, they were now maintaining those positions in a rising price environment. Every dollar silver climbed cost them money. Every week they held those positions. The carrying costs accumulated. The February 10th trading pattern revealed something critical about their situation. That aggressive selling into the close 47,000 contracts in the final hour, that wasn't profit-taking from long holders. That was defensive positioning from institutions trying to manage their short exposure. They needed silver below certain price levels. They needed technical charts to show weakness. They needed retail investors and algorithmic trading systems to see bearish patterns and sell accordingly. But the plan failed. The after-hours recovery exposed their vulnerability. Because when you're holding a massive short position and you throw everything at pushing the price down, and the price recovers within 90 minutes, you've just shown the entire market that you're desperate. History provides clear examples of what happens when large short positions meet rising prices and tight supply. In 1980, the Hunt brothers attempted to corner the silver market. Prices exploded from $11 to $50 in months. The result? Market intervention, trading halts, and financial chaos. In 1998, long-term capital management held massive derivative positions they couldn't unwind. Their collapse nearly triggered a systemic crisis requiring Federal Reserve intervention. In March 2022, nickel trading on the London Metal Exchange experienced a short squeeze so severe that the exchange canceled trades and shut down the market for days. Each situation had the same core elements: concentrated positions, rising prices, and limited ability to exit without massive losses. The silver market in February 2026 displayed all three characteristics, but there was an additional factor that made the situation more complex. These weren't independent traders holding these short positions. These were major banking institutions, the same institutions that provide liquidity to other markets, the same institutions that hold derivative positions across multiple asset classes, the same institutions that serve as counterparties to pension funds, insurance companies, and corporate hedging programs. If these institutions faced forced liquidation of their silver shorts due to rising prices, the losses wouldn't stay contained in the silver market. They would ripple through derivative books, through through prime brokerage relationships, through the interconnected web of modern financial markets. The options market was already showing signs of stress. Put-call ratios had shifted dramatically over the previous 2 weeks. Someone was buying protection. Someone was preparing for violent price movement. And the basis spread, the difference between futures prices and physical metal premiums, had widened to levels not seen since the COVID crisis of 2020. Professional traders recognized what these signals meant. The short positions were becoming unsustainable. The institutions holding them were running out of time and options. And when cornered institutions with massive losing positions try to exit, markets don't move in orderly fashion. They break. There's a warehouse in Chicago. Inside that warehouse sits a specific amount of registered silver, physical metal, bars stamped with serial numbers, weight verified, purity certified, ready for delivery. On any given trading day, the futures market trades paper contracts representing 50 times more silver than exists in that warehouse. 50 times. It's as if a restaurant took reservations for 500 customers, knowing they only had 10 tables. And for years, this system worked, because most people holding those paper contracts never actually wanted the physical metal. They wanted price exposure. They wanted to profit from silver moving up or down. They had no intention of taking delivery. The warehouse never had to deliver 500 customers worth of silver. Maybe 5 or 10 would actually show up. The rest would settle in cash or roll their contracts forward to the next month. But something changed in early 2026. More people started showing up at the warehouse. Not metaphorically, literally. Delivery notices increased. Physical demand surged. And suddenly that 50-to-1 ratio became a problem, because you can print infinite paper contracts. You cannot print physical silver. The production numbers told the story clearly. Global silver mine production in 2025 reached approximately 820 million ounces. That sounds like a lot, until you look at where it went. Industrial applications consumed roughly 500 million ounces. Solar panels alone took 140 million. Electronics manufacturing took 90 million. Medical applications, batteries, water purification systems. The list continued. Investment demand, bars, coins, ETFs, private storage, absorbed another 200 million ounces. That's 700 million ounces accounted for, which left 120 million ounces for everything else, including covering the short positions that institutions were desperate to close. But here's where the mathematics became impossible to ignore. If those institutions holding 400 million ounces worth of short positions tried to cover, even partially, where would the metal come from? Current mine production couldn't supply it. That metal was already allocated to industrial users with long-term contracts, to manufacturers who needed silver to keep production lines running, to companies that couldn't substitute other materials without redesigning entire product lines. The ETFs held approximately 600 million ounces, but those ounces belonged to investors. Redeeming them would require those investors to sell, and if those investors believed prices were going higher, why would they sell? Private storage facilities in Singapore, Switzerland, and London held additional quantities. But that metal belonged to sovereign wealth funds, family offices, and strategic buyers who had spent years accumulating it. They weren't selling either. This created what supply chain experts call a delivery bottleneck. Paper markets could trade infinite volumes, but physical settlement required actual metal. And actual metal was becoming increasingly difficult to source at current prices. The Shanghai Gold Exchange revealed this disconnect most clearly. In January 2026, physical silver in Shanghai traded at a premium of $4 per ounce over New York futures prices. $4. That is a 5% premium just for getting actual metal delivered in Asia instead of holding a paper contract in America. By early February, that premium had widened to $6. The Asian buyers weren't stupid. They understood that paper promises meant nothing if delivery couldn't be guaranteed. They paid the premium because they needed the physical metal for solar manufacturing, for electronics assembly, for strategic reserves. Meanwhile, Western markets continued trading paper contracts as if unlimited supply existed. This divergence created opportunities and risks. For businesses that required silver in their manufacturing processes, the message was clear. Locking in supply at current prices, even at a premium, was smarter than waiting and hoping prices would drop. Several electronics manufacturers had already learned this lesson the hard way in 2024 and 2025. They delayed procurement, expecting prices to fall. Instead, prices rose and physical availability tightened. Their production lines faced delays. Their costs increased. Their competitors who had secured supply earlier gained market advantage. The solar industry faced similar pressures. Each gigawatt of solar panel production required approximately 1 million ounces of silver. With global solar installation targets climbing, and with governments pushing renewable energy mandates, demand wasn't going to decrease. And unlike other commodities where substitution was possible, silver's unique properties made replacement difficult. Its electrical conductivity was unmatched. Its thermal conductivity was essential for specific applications. Its antibacterial properties were irreplaceable in medical devices. You could substitute aluminum for copper in some electrical applications. You could use synthetic materials instead of natural rubber. You could find alternatives for many industrial metals. But silver in most high-tech applications? There was no substitute that performed as well at any price. This meant industrial demand was inelastic. Manufacturers would pay higher prices rather than shut down production lines or compromise product quality. Meanwhile, recycling couldn't fill the gap. Silver recycling from electronics and jewelry added roughly 180 million ounces annually to supply, but that number couldn't scale quickly. You couldn't force people to recycle faster. The physical reality was mathematical and unavoidable. Demand exceeded supply. Paper positions exceeded physical availability. And the institutions holding those paper shorts were discovering that promises to deliver weren't the same as actual delivery capability. The warehouse in Chicago could process only so many bars per day. The refineries could only produce so much. The mines could only extract so fast. And somewhere in the world, right now, someone was placing another order for physical delivery. In September 1998, a hedge fund in Connecticut lost $4.6 billion in 4 months. The fund was called Long-Term Capital Management. Its founders included Nobel Prize winners. Its computer models were considered the most sophisticated in finance. Its strategies were supposed to be market neutral and safe. But the fund had one problem. It was connected to everyone. Major banks had lent it money. Investment firms used it as a counterparty. Its derivative positions touched dozens of other institutions. When it started failing, those connections turned into chains, and those chains started pulling other institutions toward collapse. The Federal Reserve had to intervene, not to save one hedge fund, to prevent the entire financial system from seizing up. That was one fund, one set of bad positions, one point of failure. Now consider what's happening in the silver market in February 2026. Multiple major institutions, hundreds of millions of ounces in short positions, connections that stretch across commodity markets, currency markets, and equity markets, a web of derivative contracts linking banks, hedge funds, pension managers, and corporate treasuries. And unlike 1998, this isn't hidden in some obscure Russian debt market. This is happening in a commodity that thousands of companies need to operate, in a metal that's essential to modern technology, in a market that connects to solar energy, electronics manufacturing, defense production, and financial speculation simultaneously. The institutions holding those massive short positions aren't isolated players. They're nodes in a network. Bank A holds silver shorts, but also provides prime brokerage services to 50 hedge funds. If Bank A faces losses on silver and needs to raise capital, it might reduce credit lines to those hedge funds. Those hedge funds might then be forced to liquidate positions in other markets to meet margin calls. Stocks fall. Bonds get dumped. Volatility spreads. Bank B has silver exposure through derivatives, but also trades gold, copper, platinum, and palladium. If silver moves violently, traders at Bank B might cut risk across all metals. Suddenly, the gold market experiences unusual selling, then copper. Then the entire commodity complex starts moving in ways that don't reflect supply and demand fundamentals. Bank C doesn't trade silver directly, but it holds currency derivatives with Bank A as the counterparty. If Bank A's credit rating gets downgraded due to metals losses, those currency derivatives need to be repriced. New collateral requirements emerge. Currency markets start behaving strangely. This is how financial contagion works. Not through one dramatic explosion, through 1,000 small connections that tighten simultaneously. The warning signs were already visible in February 2026 for those who knew where to look. Volatility in precious metals options had spiked to levels not seen since March 2020. Someone was buying insurance. Someone was preparing for extreme moves. Credit default swap spreads on major banks with commodity exposure had widened slightly, not dramatically, just enough to suggest that professional risk managers were becoming concerned about counterparty exposure. Margin requirements on commodity futures had been quietly increased by exchanges. A technical adjustment, the official announcement said. But exchanges don't raise margin requirements randomly. They do it when they detect increasing risk in the system. Cross-market correlations were breaking down. Silver and gold usually move together, but in recent weeks, their correlation had weakened. That suggested different forces acting on each metal, different positioning, different stress points. The bond market showed subtle signs of concern as well. Inflation expectations embedded in Treasury inflation-protected securities had ticked higher, not because of economic data, because commodity price movements were suggesting that something in the supply chain was breaking. For business leaders watching these developments, the question wasn't whether to believe the official narrative of normal market volatility. The question was how to position for what might come next. 3 scenarios existed. Scenario 1, orderly unwinding. The institutions holding short positions gradually reduce exposure over weeks or months. Prices rise steadily but not catastrophically. Supply chains adjust. Industrial users pay more but maintain operations. The system absorbs the stress without breaking. Scenario 2, disorderly squeeze. A rapid price surge forces institutions to cover shorts simultaneously. Prices spike violently. Exchanges implement emergency measures. Trading halts, position limits, forced cash settlement. The surge lasts days or weeks, then crashes back down. But the volatility destroys capital across multiple markets. Scenario 3, physical delivery crisis. Industrial users demand metal. ETF investors demand redemptions. Asian buyers continue paying premiums. The institutions discover they cannot source enough physical silver to cover their obligations. Contracts get settled in cash instead of metal. Trust in paper commodity markets erodes. The disconnect between paper and physical becomes permanent. Each scenario carried different implications for businesses. Companies with silver in their supply chains needed procurement strategies for all three: hedging programs, alternative suppliers, inventory buffers, price escalation clauses in customer contracts. Companies with financial institution exposure needed counterparty reviews. Which banks hold commodity derivative positions? Which prime brokers might face capital stress? Which credit facilities might get pulled if market conditions deteriorate? Investment portfolios needed stress testing, not just for direct commodity exposure, for the indirect connections. The financial stocks that look stable until their derivative books start losing money. The technology stocks that depend on silver supply chains staying intact. The events of February 10th weren't the crisis itself. They were the warning tremor before the earthquake. A failed attempt to suppress price, a rapid recovery that exposed weakness, a clear signal that the institutions trying to maintain control were losing their grip. And in complex systems, when control is lost, what follows rarely unfolds slowly. It accelerates. The next 14 hours would reveal whether the institutions holding those positions could regain control, or whether the mathematics of supply, demand, and leverage would force outcomes that no one wanted, but everyone would have to navigate. The professionals were already positioning. The question for business leaders was simple. Were they?